Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Welcome to The Bigger Picture. Thanks for joining us. I'm Ryan Huang, and we are looking at how against a challenging macro environment and with uncertainty set to continue, there is a growing shift towards building more resilient portfolios. But what are the considerations when putting something together, and where are the best places to diversify into right now or even reduce exposure from? Well, let's get some help from Dorian Carrell. He is the head of multi-asset income at Schroders. Dorian, thanks for joining us on the show. How are you doing right now?
It's lovely to join you this morning.
Now, let's start first with your help to describe the markets we are seeing against a backdrop of new record highs, despite the uncertainties. What do you make of it? Are we closer to complacency, or are there real fundamentals behind some of the risk-on moves right now?
I think it really depends where you look. So if you look at asset classes broadly, there are definitely segments that are expensive. The obvious ones are US IG, US high yield on the credit side, where spreads are very tight. And this is mirrored really on the equity side too. So if you look at the NASDAQ, you've got multiples north of 30 times, which is expensive, but also growth expectations of 10 to 15% earnings growth per year, which we think is a bit steep as well. So when we look at the NASDAQ and the S&P, we think you're paying a lot for very high expectations. I mean, if you look further afield, I think it gets more interesting. So, we do espouse this kind of broadening out narrative. And when you look at Europe, when you look at Asia, and when you look at Japan, the multiples are much more reasonable, but critically, the growth expectations are also likely to be surpassed in our view. So we think that you're paying not too much for very low expectations when you look at international markets on the equity side.
So with that point of view, would it then be something you'd be pushing for in the sense that it's time to reduce exposure in the US?
Well, you've got to think about where you're starting from. So if you look at the MSCI World, it's about 70% US. The broader MSCI ACWI is 2/3 the US as well. And we're not suggesting that people completely dial down the US in their portfolios, but we do think, that a move of 4 or 5%, say down from 65 or 70, would have a very interesting effect because it wouldn't affect the US market too much. It's only 4 or 5%, but the US market has a very high base. It would have a huge disproportionate effect on other markets that are much smaller, like the European, the Japanese, and Asia. So in other words, money coming out of the US wouldn't damage the US too much, but it would definitely support international markets. And that's a trade that could be interesting for people, we think.
Okay, let's unpack that a bit. So you mentioned a couple of places to look at, Europe, Japan as well. Now, with the tariff talks going on, what are some of the places to zoom in more specifically at?
Yeah, I mean, it's sort of minute by minute, isn't it, on tariffs? I mean, I just saw the news on Brazil overnight. We have... in the region, tariffs on ASEAN countries and the Trump administration really targeting the kind of pass-through goods from China. But we think it's probably best to take a step back and think about the key countries. So, the UK's had a deal, but the UK isn't critical, but it shows where things might go. And the deal isn't particularly detailed, but it covers various principles. So we think the same thing's going to happen in Europe. We think Japan and Korea now are pushing very hard for deals, despite the headlines kind of moving up and down. But we think you will get deals with countries or regions which have something to offer the US administration. To give one example, Japan is the second biggest holder of US Treasuries, and therefore has quite a lot of leverage in these negotiations. We think countries or regions with leverage will do best, and there will be deals, but they won't be too detailed.
Okay. Part of the equation is a weaker US dollar. It's been softening in the past few months. Where do you see it going? How does that play a part in your considerations?
We have in our growth and income strategy about 75% US dollar weight, which is very low for us. We've had up to 100 in the past. And we've often seen the dollar as a good hedge alongside duration. We think both of these areas are challenged now Clearly, the US policy in terms of the Big Beautiful Bill, in terms of financial deregulation, tariff policy, and labour market policy are all quite potentially inflationary over time. We think that's another area that's going to discourage international investors from buying the dollar or buying treasuries, for example. So we do think that the whole thrust of policy, both political and fiscal, is pointing towards a weaker dollar over time. So that has many implications for investors.
Okay, and that could potentially mean as well a stronger currency for many emerging markets. Does that help support the outlook for those places?
Yeah, I mean, we've quite a high allocation in both our income and our income and growth strategies to emerging market local debt, and that's unusual for us. So, you have higher yields, the rate cycle is further advanced in emerging markets, but also we think you're going to have stable or appreciating currencies. Therefore, you will pick up the yield plus potential appreciation. So, that gets a lot more interesting. So on the local debt side. And then in terms of, stability in the currencies as well, it tends to attract flows and, potentially in equities, the returns based in dollars are higher with the currencies appreciating. So, everything turns around, if you like. And it's a fascinating time. But broadly speaking, we think people will be more interested in emerging markets, starting with local debt, but also on the equity side as well.
Okay, so we talk about the idea of putting together a resilient portfolio. What sort of questions investors should be asking? What would it look like? Is this still a 60-40 split? Should we be looking at more non-correlated assets in this time of uncertainty?
So I think the days of 60-40 are probably behind us, simply because the destination in terms of treasuries is very uncertain going forward. So, US short-end rates, do they really need to be cut when unemployment's at record lows? You have a lot of stimulus in the economy. The only thing that's really holding it back is tariff uncertainty. So at the front end, it depends on who Powell is replaced by next year, probably. But also further out the curve, when you think about the yield curve, a lot of the policies of the US may steepen the yield curve, basically. So that means that it's more dangerous to hold duration than it was in the past. So the 60-40 in terms of the 40 in fixed income is a bit vulnerable. Therefore, what we think people should do is that if they just want income, diversify the income sources, look at things like Australian investment grade, look at European high yields, swap back into dollars or Hong Kong dollars or Singapore dollars, and look further afield. We have allocations to things like insurance-linked securities that yield 12-13% that are floating rates, and securitized debt. So you need to broaden out on the fixed income side. The other way of looking at it, though, if inflation does persist, and it does look likely in the States at least, you need more growth assets. So one thing you could do there is to use equities. Obviously, international equities we would suggest having a higher weight than in the past. But an asset class that's totally overlooked at the moment and is coming back very strongly, convertible bonds. And, that's something that we've been incorporating in our income and our growth and income strategies much more in recent time.
All right, great considerations in building that portfolio that's going to be more resilient for you in these uncertain times. Helping us out this morning has been Dorian Carrell. He is the head of multi-asset income at Schroders. Dorian, thank you so much for your time and insights. It's been great chatting with you.
Thank you so much. It's been a pleasure.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.